Hi guys, so let's now take a look at oligopolies. Okay, so when it comes to oligopolies, we're dealing with a handful of firms that dominate the overall market. If you think of oligopolies, we've got some great examples here in the UK. The supermarket industry, of course, is a classic example, as are mobile phone manufacturers, mobile phone network providers, broadband providers, you name it. There's a lot of oligopolies out there. Okay, so as we've heard, characterized by a handful of firms who dominate the market. Now there's some key assumptions within an oligopoly market. Firstly, that firms are interdependent. This means that the actions of one firm will have repercussions for other firms. So for instance, the actions of Lidl or Lidl supermarkets will actually have repercussions for Tesco's, for Sainsbury's and so on. They're likely to have heterogeneous or differentiated products. There can be some exceptions to that. However, in most circumstances they will certainly have an element of non-price competition being used here, okay, where they deliberately brand and set their product apart from others by doing something different to it. Okay, they are also profit maximizers, of course. As profit maximizers, we would hope that they would want to reinvest in the future to further improve these differentiated products and services that they can offer. Okay, and finally, we can also see that there's going to be big barriers to entry and potentially exit in trying to compete against these companies. Great example that I've looked at in previous years has been the People's Supermarket, which was set up in London to try and compete against this other supermarkets, the normal supermarkets that we consider. Now they had deliberately undertaken a structure where they employed volunteers rather than employees, and that enabled them to actually maintain a low enough cost structure to be able to compete with other supermarkets. But without that advantage, there's no way they could have competed otherwise. So you can look that up, but the volunteers then get a 10% discount, something like that, per shop that they actually want to undertake in the supermarket. Right, next thing to just focus on is the market concentration. So when it comes to the market concentration, it refers to the combined market share of the largest firms in the industry. And it's common to look at a four-firm concentration ratio. So the four-firm concentration ratio within the supermarket industry may be perhaps 80%. Right now, there is of course talk of the Asda and Sainsbury's merger going through, in which case Asda and Sainsbury's together with Tesco's would then have a two-firm market concentration ratio of 60%, a whopping 60%. So really, it's understandable that the Competition and Markets Authority wants to investigate that and find out whether that might be against consumer interest. Okay, now we mentioned this point about interdependence. It's so important. It's so important in oligopolies, okay? And there's two types of collusion that's likely to take place. Firstly, implicit collusion. Implicit or tacit collusion, as it's also known, is actions that minimise the response from competitors. This is things like price guarantees. Consider John Lewis never knowingly undersold. What does that say? Well, it is a price guarantee, in essence, saying that they will match the lowest price that you can actually find those consumer goods for. Okay, so that applies to their electrical goods that they sell. Now, that low price guarantee is really just a little nod to their competitors by actually saying, do you know what? We know what prices they charge and we make sure that we're pretty much in line. But it is not going for an out-and-out price war. Oligopolist firms don't like undertaking price wars, okay? It can be very damaging for their profits. They don't like it. So then we've got explicit collusion. Well, this is nastier. This is more sinister. Explicit collusion means an actual formal agreement between firms in the marketplace to actually restrict output and raise prices. Okay, so this is agreed actions to restrict output and raise the prices. This is, of course, the detriment of the consumer. It will mean that, in essence, the industry will turn into an effective monopoly. Now, it can be therefore very damaging and lead to a significant deadweight loss, direct consequence of that. Okay, so lots of interesting points. We'll delve a little bit deeper into looking at these different types of collusion in our next lessons. Thanks, guys.